Hello everyone and welcome to lesson 7 of our 8-part New to Investing series. I'm Alex Coffey and I'm a senior trading and derivative strategist here at Charles Schwab. I'm also the host of Next Gen Investing on the Schwab Network. For those who aren't familiar with Schwab Network, it is produced by Charles Schwab Media Productions and it is a separate but affiliated subsidiary of the Charles Schwab Corporation. Should also mention that this is a moderated discussion and my colleague Connie will be in the YouTube chat to help answer any questions you may have for those who are joining us live here today on this Thursday. Today's session is called Risk, Reward, and Avoiding Emotional Traps. I think this is a really important point in this series because last session we started to put some of the pieces together and we talked about building perhaps what could be a first portfolio. Today we're going to start talking about what happens next. So before we get into the presentation, there are a few important disclosures to get through here. Today's discussion is for general informational and educational purposes only. Nothing we discuss should be considered investment advice or a recommendation. Towards the end, we'll pull up the schwab.com web platform. I'll be operating in a demo experience, so there could be some differences between what you may see on a live platform experience from the demo. Here's where we're at in the series though. We've covered a lot already. Tons of important information, especially for those who are maybe just starting to get into some of this this journey, really, a lifelong journey of investing. We've started with theory. We've gotten a little bit into what practice could look like, and so I encourage anyone who's joining us live who maybe hasn't seen parts 1 through 6 to go back and watch those when you have the time. Towards the end of the program today, I'll show you where they're archived and they're actually available for on-demand viewing, and we'll do that at the end of the presentation. So today we're going to move into risk, reward, and emotional discipline, and that matters because investing isn't just about picking the right investments. It's also about having a process, and having the right process for you can help you stay invested and make thoughtful decisions when markets move around. And then next week we'll tie it all together and we'll talk about how to navigate hype and headlines as well. So here's our plan for today's session. First, we're going to dive into risk and reward, and we're going to really discuss how those two are interconnected. They're two sides of the same coin, I like to say. We'll then start to unpack the importance of emotional discipline, and this is a lifelong journey, especially that piece. I mean, you could have been doing this for decades and decades, and the emotional discipline aspect and the fears and the fears of missing out and all the things that go into the decision-making process really are things that you just hope to get better at. You never really completely conquer them. So it's important to know that that's normal. We'll talk more about that. After that, though, we'll try to piece this in. We'll look back at last week we built a watch list of names and discuss maybe what a sample portfolio would look like with 5 different stocks, and we'll go into the Schwab.com web platform and we'll look at a few of those companies and we'll try to illustrate some of these concepts using those real-world companies and how their prices have moved around to illustrate things. All right, definition time. So this is where you just got to bear with me for a second. We'll get through some of this, and then we'll talk the more fun stuff, which is looking at some of this stuff on the platform. But let's start with the two most important pieces, particularly for this lesson, but for the discussion as well, and really for this journey, which is risk and return. So risk, if we're really going to try to make it simple, it's essentially the chance that investment can lose value, and it's also the magnitude of the loss as well. The return is how much that particular asset has actually moved up or down. And so that is your performance, that's your gain, that's your loss. Volatility is how much uncertainty and and movement is really in the marketplace. So this can be what the market perceives as uncertainty, or this can be the realized uncertainty. And so volatility is the movement. And then diversification, we had a whole topic on this. I believe it was session 5. And this is essentially just the concept of not putting all your money in one place, not all the eggs in one basket. And as we start to look at these different terms, concepts, parts of the investing landscape, the basic idea is this. Risk and reward are connected. I like to say, again, I said it already a couple times, I think, risk and reward, two sides of the same coin. And the reason that is because, and this is just logic, right? For an investment to offer more potential reward, that usually means that there's greater uncertainty and greater movement, or to use the term, greater volatility. So if something's going to double in price, that means it has the potential to double in price. And if it has the potential to double in price, it's moving quite rapidly, potentially. Where that uncertainty isn't automatically bad, it should be understood. So use a kind of an example. You know, money that you have just parked in a savings account or a checking account, that can feel more stable because it's not moving around, on the page the same way that an investment in a stock portfolio might. But it's also not moving around like a stock portfolio might, because that movement can mean that your money is creating more money and growing. And so it's more stable potentially, but it may be giving up long-term potential. And so the other way, stocks can potentially offer more growth over time, but they also move around. And depending on how often you may need that money, it may not make sense to invest capital. And if it's something that you can set aside for a longer time horizon, perhaps it does. And so it's a unique question that every individual has to go through on their own. But there's gives and takes. And so for a little bit more risk, your potential for reward can increase. So to kind of tie this together then, investing isn't about avoiding risk. That's not really realistic. It's more about understanding the risk that you're taking and making sure that they match your goals, they match your time frame, and that they manage themselves through a plan. And by looking at things from a high level and having a process, you can start to take risk in a calculated way that makes sense for you and your goals and your time frame and your individual picture, and then ultimately potentially have greater reward potential as a result. So that's where I want to kind of connect this back to last week, and we'll get into this more towards the end. But we talked about a simple portfolio. We used a couple different names. We said Apple, we said Nike, we talked Delta Airlines, Netflix, and Eli Lilly. Now, none of those are, of course, recommendations, but it's useful to help thinking about how these different businesses bring different things to the portfolio. So the point's not whether one is good or the other is bad. The point is to sort of look at each of them as individuals playing a role in thinking about, how much of this portfolio should be tied to any one of them or any one sector or any one, just generally asset class even. So you might just think things broadly like stocks or bonds or cash or gold or, take your pick. But as we move along here, that brings us to position sizing. Position sizing is essentially just the decision around how much am I going to put into an investment. And the important part about this is that even good companies, great companies can have bad years, bad days, bad weeks. They can disappoint you, and you can really like the stock and it can still move lower. And so the question becomes basically around, if I'm wrong on this investment, how much damage can it do to the overall portfolio? And so if we use this simple example that's on the slide there, say you have $1,000 to invest, you put it all in one stock. The other option is that you split it around, kind of like we discussed last week, into 5. If one of them moves 30% to the downside in option A, you're down 300, But if that happens in option B, that one position is down 60 and the overall portfolio is in a little bit better place, assuming the others just maintained where they were. And that's a very different emotional experience as well. And that's the important point about position sizing, is it's one of our key risk controls that we have control of, which at the time of order entry, we can decide how much we want to put at stake. That allows you to kind of stay invested. It helps you avoid making emotional decisions and survive mistakes, because inevitably we're going to make them. And this last piece, or this next piece, ties to that last thing I said, which is we're going to inevitably make errors in this journey. Everyone does, and it's unrealistic to assume that you won't have investments that, at least at points in time, don't work. And so that's why it's important to manage risk and create a little bit of self-discipline around the processes that we build, because they can help us curb some of the emotional urges that we have to, react to things when maybe it doesn't make a ton of sense if we were really in a less emotional state. So if you were a newer investor, I think the easiest way to simplify this is thinking about risk management tools and processes are really around thinking about things ahead of time, and so that you have a plan of action for various scenarios, so that when the emotions start to take over, you already know what your course of action is going to be. So when markets are calm, it's really easy to just stay invested and wait it out. But when the market's moving around a lot, or a stock moves down a lot, it can be a little bit different. It's sort of the everyone's got a plan until they get punched in the mouth concept. And so having the plan, having the process, and doing this over time helps make that emotional discipline a little bit more. And so some of the questions might be, how much do you want in a position? How much or what kind of performance would make me want to potentially add more, stay where I'm at, maybe take a little bit off, or maybe just sell out the entire position altogether. And so when you're doing this, it's important to think about what you were reacting to, or what that decision-making trigger was. And it could be the price. It could be the company come out with a new business plan, or some new idea that changes how you feel about it. But having those questions can slow you down, and in an emotional state, sometimes slowing down is really one of the most valuable things that we can do. So again, the goal is not to avoid the risk altogether. If you invest, there's going to be periods of time that those particular investments, no matter what they are, go down. It just is an inevitable part of this process. And the goal is to manage that so that normal market movement doesn't knock you off your course and doesn't knock you off your plan. And this is where the emotional discipline side of things becomes very important. Fear can lead us to selling after prices have moved swiftly, particularly to the downside, if you're long stock shares. Excitement can make you feel that you need to jump in, and this can be after the price has already moved significantly. And that kind of ties into FOMO as well, which is you have a friend or family member who has a successful investment, and you feel left out, and you feel like you need to jump in, and it might be not necessarily the best time. And that's where asking these questions and slowing things down can help you make a not emotionless decision. That's not the goal, but maybe one that is still disciplined and follows your general plan. Overconfidence is another thing that can kind of derail many. So maybe you have a few good investments in a row, you start to feel overconfident, and one overly risky investment can really set you back. So again, none of these are unusual. They're normal. They're human emotions, and the goal isn't to remove them, but it really is to try to learn to have them be less impactful to the decision-making process. acknowledging they're there, knowing they're going to be there, but not having them, basically steer the whole ship. And so if we pull up the platform here, I'll go ahead and do that. We're on our watch list. We can see our, 5 stocks that we discussed last week, and you can even see today, the movement is quite dramatic, and 4 of the 5 are actually lower on today's session. When you look at them though, and we'll just click on Apple. I mean, Apple is going to be a big name today, has got earnings today, but when you look at it, one of the things that stands out about Apple is that when you look at it on a year-to-date basis, it's done quite well. When you look at it on a 1-month basis, it's done quite well. When you look at it over the last week, it's done quite well. But of course, when you look at it on a 1-day basis, down a little bit. So it's important to know sort of what your time frame is, and when you look at it over 5 years, and we could even show more here, what's happening today doesn't even really register. Like I'll pull up 5 years here on this bigger chart. It's down, and you can barely even see it on the chart. And so it's important to really define what your goals are for your investments. But by looking at this bigger picture, you can see it's normal for Apple to go up and down, and it will continue to be normal for Apple to go up and down. But over time, over the last 5 years at least, this has generally been a stock that's done well. And for those who have followed along in our journey here, they'll know that Nike has not particularly been a positive one over the last 5 years. So to balance the discussion, we can look at that same 5 years, and Nike's really struggled. And so the point isn't to compare which one's better, or which one is the one that you should be invested in or shouldn't be invested in. That's not really the discussion topic. The point is more to recognize that the different companies can behave differently. And so if an investor owns a group of names like this, the goal is to think beyond just the symbol and think about what drives each one, what can go right, what can go wrong. How much do I want to be exposed to each one of these companies? And if one of them moves swiftly, maybe they have an earnings announcement and it's disappointing, is that going to be a problem at the portfolio level, or is it just a position level problem? And there's a difference between owning stocks and managing a full portfolio. So for newer investors, a few habits that can help. First, just know why you own something. If the reason is just because it's going up, maybe that's enough, but maybe it's not. The second is decide the position size before the emotions show up. So I would say, hey, we control a lot of our risk at order entry. So we decide how much we want to buy if we want to buy something, and try to do that when the emotions are not really ramped up. Third, use the time frame as a filter like we have for our chart that we had on the screen. Especially for Apple, when you look at it, Apple on that longer term time horizon, it really puts into perspective that, yeah, the stock's going to move around, but the idea of investing is that over time they compound and these companies that are successful do grow. Fourth is to remember losses happen. Nike's a good company in the sense that people know what its products are. It's extremely recognizable. Many of you may even have Nike shoes that you're wearing, or a Nike shirt or shorts that you wear when you go to the gym. Yet we just looked at the Nike chart, and it's certainly not been a very good investment over the last 5 years. And then fifth is just to avoid reacting too dramatically just because something has moved today. Sometimes it means actions need to be taken, but other times it just means that price has moved, and the context around it is really the most important piece. Okay, and so as we start to tie this all together here and think about what ultimately this is all about, is to remember that risk and reward are two sides of the same coin and forever connected, and to understand that the emotions we feel, whether it's fear or FOMO, they're normal. but the discipline around the decision-making process can help prevent them from overtaking that decision-making process. And so that's ultimately going to bring us to the end of Lesson 7. Next week, we'll finish the series with Lesson 8, and that's going to be around navigating hype and headlines. That'll be a great follow-up to today's discussion because once you understand risk and emotional traps, the next step is to beginning to learn how to filter news and headlines and trends and market noise. Should also note, too, that next week we'll conclude, as would make sense, the 8-part series for the New to Investing series. And as I mentioned, the lessons will be available on-demand viewing on our YouTube playlist. So what I would say, and you can see that YouTube playlist here on our board. Let me pull it up real quick. And so when you go into the Schwab Trader Talks webcasts, you can go there and just go to the playlist section. And where you'll see it is New to Investing right here. And you'll see some of those other webcasts there that you could go back and visit. That said, after you've gone through these 8 lessons, if you're ready to continue your investing journey and you're ready to move on to the next level, our Stock Investing for Beginners webcast that's available on Wednesdays at 4 p.m. Eastern Time, that's a great kind of next step. And that's where we create and trade specific sample investing plans and where you can start applying many of these concepts that we've covered throughout this New to Investing series. So I encourage you to check that out as well. And thanks again for joining us, and I look forward to next week and our final session.